Well, good morning, good afternoon, and good evening, one and all, and thank you very much for joining us for another installment of Michael's Global Liquidity Update. There will be time for questions at the end. So, Michael, over to you.
Good, thank you. Hello, everybody. Thanks for tuning in. This is likely to be an interesting and actually quite a big week. It's the Jackson Hole week, and you're going to hear a lot more about yield curve control, modern monetary theory, and average inflation targeting. In other words, the mnemonics YCC, MMF, and MMT and AIT. And basically, what I want to do is to outline some of the problems with some of those ideas, and basically give an overview as to why we're still upbeat about markets, certainly about risk assets, why the outlook is not as bleak as many people would suggest. There is an inflation problem upcoming, which is why we still strongly believe in gold. But, you know, as an opener, let's say that all the criticism that was fired at Japan in the 1980s and more recently in the last decade about China now applies in spades to the West. You've got directed credit growth and effectively zombie banks. And what policymakers are doing, it is using liquidity as a lever to get returns up and wealth effects created and economies revived. And we're going to see more of that, I think, rather than less. In terms of the liquidity picture, let me just flash up where we are right now. What we've been seeing, certainly since maybe even late last year, but certainly with some alacrity since March and the COVID crisis, is a V-shaped rebound in liquidity that may be just about peaking out. But bear in mind, these are momentum measures, and there's no real loss of momentum in terms of liquidity going on. There's still a lot of cash which is going in. And actually, arguably, particularly if you look at the US, if the take-up of liquidity had been greater from the private sector, we may actually have been seeing even more liquidity growth. To kind of put that in context, and I'll come on to some supporting evidence in a moment, what's different about this QE is it's about 5 times the size of what we saw after the global financial crisis in 2008-9. That's not insignificant. And that's what a lot of market participants, I think, missed coming back to March, was the size of the pool of liquidity that has been thrown into markets. So 5 times as big as what we saw before. What's more, that QE is being much more directed at the real economy than any previous QEs. As we've said many times over recent months, if you go back to 2008-9, banks were the problem. Banks are now the solution to this problem. It's a very different type of policy response. Most of the liquidity last time went into the wholesale markets and inflated asset prices. A lot more liquidity this time is going into, if you like, the retail markets. It's going into the real economy. And you can see that in a number of ways, but most obviously, one would say, is things like house prices are starting to move, inflation is beginning to pick up, business surveys are rebounding very strongly, etc., etc. And I think that's likely to continue. It's not fanciful to suggest that what we would likely see in the next couple of months is maybe PMI surveys up as high as 75. Now, although that may sound a ridiculously high number, bear in mind what that says. It just says that 3 out of 4 participants in the surveys think things are getting better. So it's not impossible to suggest that might be the outcome. And the question to ask is, how would stock markets and how would bond markets react to that environment? In terms of some of the risks, we think that the risk upcoming is inflation. We're already getting inflation. If you look at the US inflation numbers last month at an annualized rate, which I suppose one shouldn't really do, but it was up at about 9%. And the point being is that we are getting inflation. At the moment, this is what we would call monetary inflation. It's not really coming through in a sustained way in terms of the high street yet, but that's maybe just a question of time. And monetary inflation is very visible in markets like equities, in the gold price, and in house prices. And then I'm going to say something about Europe, Asia, or the US. Where should you be putting your money later? But ultimately, what we're seeing is money which is moving out of US assets. The dollar, which has been in favor for much of the last 5 years, maybe 10 years, is certainly losing its luster. Gold and the euro are taking over. Now, let me just add a point on this slide here, which is looking at Wall Street, and it's looking at the reaction of Wall Street to economic data. Now, on the left and the right-hand slides, the right hand is just a magnification, if you like, more recent data of the left-hand slide picture. The left-hand side is a long-term plot of US investors' risk positioning, or as we call it, risk appetite. That has a mean of 0, and anywhere in the negative territory tells us that investors are basically taking a lot less risk. They've got their portfolios more skewed in to safe assets like government bonds or cash. And you can see where we got to back in March, April of this year, where the yellow line, which is what that's indicating, suggested that we were down at extremely low levels in terms of risk positioning. In other words, there was virtually no equity being held. In fact, one of our clients in the US told us that Fidelity had indicated that something like 20% of their client base had sold every equity they owned at that point. And that was really indicative of how much investors panicked. The red line on that chart is looking at US economic expectations, which have actually come from the various Fed regional surveys and the Michigan Consumer Sentiment Survey. And that really is a guide to say, how do investors think, or how do participants think the current situation looks relative to the long-term average. And what you can see now is there's a very decisive rebound. Now, the point of putting that chart up is it's more or less saying that actually Wall Street kind of looks up with events, or events look up with Wall Street. The economic environment and the investment climate don't look significantly out of line. And we don't believe there's a bubble forming in the US, certainly yet. And let me demonstrate that with this next slide, which is looking at how do you value equities. One way is clearly against earnings, another way may be against book value, a third way may be against dividends, and a fourth way here is against the pool of liquidity. All are valid. Markets tend to have different valuation benchmarks at different times. Liquidity, we think, is all important, certainly right now. And if you look at the left-hand chart, that's looking at the ratio of all equity holdings worldwide, basically divided by the pool of safe assets. The pool of safe assets is defined as bank deposit accounts, short-term money market funds, and government bonds in the developed markets. And that is pretty much unextended. I mean, it's around its average levels, I would say. We projected that to the end of 2020. What that suggests is that given the huge amount of bond issuance that is slated to occur and the liquidity that is still yet to be put into markets, that could even drop down from current levels. If you look at the right-hand chart, which is simply taking liquidity, global liquidity as the denominator of that ratio, you can see there that markets don't look particularly out of line. So from a liquidity standpoint, hey, where's the bubble? There's no evidence of that at all. What commentators have missed is the fact that there's been a huge amount of liquidity thrown at markets. Liquidity is out there and it has to go somewhere, and it's going into inflate asset prices right now. Viz the parallel move in house prices that we're seeing in many economies, and it's going into equities, and it's really as straightforward as that. Now, the concern we've got clearly is that there is inflation coming, and just to put that into context, a chart that we very often show is the right-hand chart, which is a long-term history, in fact, here of US M2 money growth. Liquidity is a bit different, but in actual fact, right now, M2 money growth is actually growing faster than our broader measures of liquidity, to put it in context. But many people would take M2 as a driver of real economy inflation, which is probably not unreasonable. And what you can see is that in the long-term history, going right back to the turn of the last century, the start date here is 1915, there has never been an occasion where you've had anything like this degree of monetary growth. And the concern we've got is that that is going to come through in terms of higher inflation at some stage. Now, what does that mean? Well, the valuation diagram that we use on the left-hand side is something that is worth bearing in mind. And that basically says that if you look at the three key asset classes, bond markets in red, in orange, you've got equities, and the black dotted line is real assets. Now, very neatly, real assets and bonds are kind of like a mirror image. So if you look at inflation along that lower axis, as inflation starts to pick up, the implied valuation of bonds, in other words, the inverted yield, tends to drop away, so valuations fall. And what you find is that correspondingly, the implied valuation of real assets goes up in a mirror image. Equities are kind of different, is that equities have a sweet spot at around about 1–2% inflation, and that's when they see their highest valuations. Either side of that, equities get derated. Now, there's clearly a period where you can see as inflation accelerates that the valuations of bonds drop a lot faster than equities, and equities don't tend to react very much to the initial phases of an inflation pickup. And I think one of the things we're likely to see over the next 12, maybe 24 months is that there'll be more investors shifting out of fixed income into equities because they've got more of an inflation hedge in the equity markets. Now, is this something we ought to be concerned about? Well, you pay your money and takes your choice, really. But certainly one of the things that we would highlight is the charts here, which are looking at the background for the gold price. Now, the left-hand chart is basically looking at gold in log terms. The reason for drawing it up in log terms is that you get a much better idea of periods of more rapid inflation, because a straight line on a log chart is telling you a rate of growth. And what that is basically showing is that the rate of growth of the gold price has had, if you like, certainly two, arguably three, including the current, periods of very rapid expansion since the mid-1960s, effectively at the end or the latter days of the Bretton Woods fixed exchange rate system. And we're in now, I would say, another great monetary inflation. Now, the interesting question to pose is that if you look at the first great inflation, monetary inflation in the 1970s, that coincided with high street inflation. The middle one, if you take the period from the early 2000s, did not. The latter one, question mark, jury is out. So what are the differences between the first and the second there? The differences are that if you look at high street inflation, in our view, is a combination or a hybrid of monetary inflation as well as cost inflation. And what you saw very clearly in the early 1970s was a big monetary inflation visible here, but also a cost inflation as wages went up and oil prices went up, as OPEC hiked oil prices in the early 1970s. Now, that background fed through into high street inflation. If you go to the middle period, the period in the early 2000s, there was a big monetary inflation then, but it did not translate into high street inflation because simultaneously we saw a cost deflation. And that cost deflation is well rehearsed. We know why it's happened. It may be demographics, it may be factors like globalization, it may be technology, but all those factors effectively helped to put a lid on that inflation pressure because cost deflation was paramount. What we're seeing now, I would suggest, is a monetary inflation with still some likelihood of cost deflation, but nothing like what we saw in previous years. So the odds are that you're going to start to see some feeding through of monetary inflation into the high street. Now, you don't need that for a higher gold price. A lot of people argue, and I think incorrectly, that gold is an inflation hedge. It's not necessarily, it's only hedging the monetary inflation element of that. And what we show in the lower chart, the lower right chart, is the gold price drawn in blue there, and two other lines that we put on top of that. The yellow line is basically a measure of liquidity, and that's, if you like, the log of liquidity going back again to the early 1960s. And the grey line is the same analysis, but for inflation. And the point that I would make just visually here is it looks as if the gold price is a much better tracker of liquidity than it is of high street inflation. And the reason comes back to the earlier discussion of, are we looking at monetary inflation? Are we looking at cost inflation? The question is that what gold is representing is monetary inflation, not cost or high street inflation per se. The top right-hand chart is a way of maybe thinking of how much gold could go up. And what we try to say here is that ultimately monetary expansion must be related to the amount of debt that's in the system. In other words, if governments want to make debt good at some stage in the distant or far distant future, what they're going to do is to print money to offset that debt, to neutralize the debt. And that will give you a gauge as to how much or what the ultimate monetary expansion will be. Now, if you look at that top right-hand chart, that's looking at the ratio of gold stock to US debt. And the long-term average has been around about 20-25% or thereabouts, if that's a decent benchmark. But, you know, hey, it's a benchmark that maybe people can think about. And what this is really saying is that given the fact that the gold stock doesn't really change, it's very difficult to extract gold, and that's one of the factors that makes it valuable. The only way that the gold stock is going to change is if the value goes up. So in other words, the price of gold elevates. And what this chart is basically telling us is that if you get back to that benchmark norm of around 20-25%, the US dollar gold price to equalize that debt will have to be about 2,500. And that, interestingly enough, is not dissimilar from the sort of numbers that one would get looking at current rates of liquidity expansion. So I think the gold boom is here. I think it continues, and I'm saying that it's likely to be 2,500 at some stage, maybe in the next 2 or 3 years. Of what the gold price could head up to, and that will be associated with some monetary inflation as well. Now, let me move on a little bit to this chart, which is looking at spelling out the differences that we're getting in terms of monetary growth between, or liquidity growth between, what happened in 2008-9 GFC1 and what's been happening now. And the evidence here, I think, should be pretty straightforward. The top two charts are more or less the same. They're telling the same information. One is in dollar terms and the other is in annualized growth rates. And what it basically illustrates is that the yellow line is where we are today, the 2020 data. And for comparison, starting at the same crisis point, we looked at what was going on in 2008-9. Now, there was a pickup in liquidity in 2008-9. We all kind of remember that. That was QE1, then QE2, and ultimately, at some stage later, QE3. But the scale here is just dramatically different. And that's the point we've just got to recognize. So what you see here is huge liquidity expansion. The second thing, which is shown on the bottom left-hand chart, is how much investors pulled cash out of the market, And what this basically illustrates is the holdings in the US of institutional money market funds. And this is the growth rate that these funds basically exhibited around March, April. And it goes back to the comment I made earlier about what Fidelity's clients had done, liquidated most of their equity positions. This is just unprecedented. The media have sort of scared people out of financial assets or risk assets. And the spike here was absolutely nothing like what you saw in 2008-9 in terms of cash on the sidelines. So there's been a huge amount of money which has been available to go back into risk assets, and that's one of the reasons we've had this V-shaped rebound. Are we going to get a V-shaped rebound in the real economies? Well, I mean, I don't see any reason why not, in fact. I think that from experience, what one sees in these sort of cathartic moments, when you get these disasters such as COVID, actually the world economy ultimately comes out of this thing stronger. The growth trend, could be faster 2 or 3 years down the track than many people are expecting. And, who would have thought in 1946 that the world economy was going to experience 3 decades of significantly more rapid growth than anyone had seen before? And this at least gives us the ability to retool around new technologies, and it gives the new generations, the millennial generation, a way of sort of taking control, perhaps. What you can see in the lower right-hand chart is the difference between broad money growth or broad liquidity growth and M1 narrow money. And the point about this is that unlike what we saw in, again, 2008-9, although I haven't got the data on the chart, but believe me, it was flatter then. What you're seeing now is much, much greater growth in retail aggregates. In other words, money is going into the real economies. People are spending. And coming back to this point about, criticizing Japan and China over previous years for directing lending and running zombie banks, that's exactly what Western governments are currently doing. They're trying to get banks to lend into certain segments, into certain sectors. They've got, credit growth is being pushed out. And that is what's going to drive economies higher. So I think the point here is that this is, whether one believes that it's productive or unproductive spending, the fact is the real economy is getting quite a lot of cash. I'll come back to this chart in a second, but I just want to focus on this one. On the left-hand chart, we show world business confidence. This is simply an aggregate of all the big headline surveys, the US ISM, the Tankan in Japan, the CBI in the UK, etc. Various business confidence surveys across Europe. And it's aggregated by market size or economic size. And what we show here is global liquidity, which is the red line on the left-hand graph, advanced by 9 months and just plotted on top of that business confidence data. And what you can see is that lo and behold, the two are tracking together, and you're seeing a marked expansion in liquidity. That is likely, we think, to come through in terms of the right-hand chart, which is showing shipping activity against capital flow. One of the interesting points that you've seen right now in this crisis is there has not been a collapse in global capital flows, as many people predicted. And as you saw in 2008-9, it just hasn't happened. Capital flows have been quite robust. And that would suggest that shipping activity is likely to rebound again. And in fact, latest data up to the early part of this month from Korea is suggesting that you're getting a further rebound in export growth. So that's good. The problem that maybe we can see, if I go back to an earlier chart, is the right-hand chart here, which is looking at China. And the point is that China is simply not easing policy. It's staying, sitting on its hands. What you've got is a demonstration on the right-hand side of the People's Bank's balance sheet. And the point that we've made probably repeatedly over the last few years is that the engine of change, or the lever of change in China, is increasingly that black area, which is holdings of domestic assets. Previously, prior to 2015, the Chinese ultimately monetized Forex reserves, and that was their way of actually increasing domestic liquidity. And Forex reserves were expanding simply because you had a situation of a big trade surplus, which, hey, they've got again, in fact, and you had a lot of capital inflow coming, and that was monetized. Since the 2015 and the capital flight from China and the loss of foreign exchange reserves, with that orange area going down, the Chinese have used domestic monetary policy much, much more in terms of open market operations. And that's how they control liquidity in China, and it's very tightly controlled, as one would suspect. Now, what you can see on that black area is how they've basically managed policy over the period. And basically, they've run their monetary policy, certainly over the last 2 years, by flatlining the balance sheet. And they've tried to contain credit growth as much as they can. This is attempts to rein in some of the shadow bank lending. There is no evidence from what we can see that China is changing its course. The red line is looking at an annualized 6-month growth rate. And that, again, is basically, around, let's say, around 0 to be generous. but effectively there's no big expansion. Now, in fact, in truth, if you dig into the data, what you can see is China is actually operating a kind of bifurcated policy in a way. Is although the People's Bank's balance sheet is flatlining, they're also encouraging the policy banks to do more lending and the state-owned banks to do more lending at the margin to try and take the squeeze away from small to medium-sized businesses. And so there is an expansion at broader liquidity levels in China. But basically what they seem to be doing here is they're engineering a flat People's Bank's balance sheet. Now, why would they be doing that? And I think the obvious answer is that they're basically managing the currency. And what you've seen in past crises is that China basically wants to see stability. It's very scared about losing control. And one of the things they focus on very clearly is the yuan. They want the yuan to be stable, and actually, hey, they've achieved that in recent weeks and months. So policy seems to have been successful by keeping money market liquidity pretty tight. Now, if you extend that comment to the rest of Asia, I would say arguably Asia is increasingly operating within a yuan or Asian currency zone. And more governments in the region seem to be tying their currencies more closely together. Even the yen, the degree of volatility among Asian currency pairs has dropped away very significantly over the last 2 years. And I would argue from about 2017, the BOJ was actually actively, or the Ministry of Finance in Japan via the BOJ, were actively trying to stabilize the yen through that period. I've never seen the yen anything like as stable as it's been over the last 2 or 3 years. So I think that what you've got is an attempt to stabilize currencies in the Asian region. And what that means is that whenever capital flow leaves the dollar, which is probably beginning now, what you are seeing is the beginnings of, or you'll see the beginnings of a monetization across the Asian region. And if China eases at the same time, that's going to be extremely positive news for emerging market assets. Now, let me say something about, I'll come back to the yield curve stuff, but let me come back to turn to the dollar right now. And I think it's very illustrative to look at the left-hand chart there, which is monitoring capital flow by broad region. So we've got Europe, Asia and the Americas depicted here. I mean, for the Americas, just read the dollar because that's really the bulk of it. For Europe, although the Swedish crown, the Swiss franc and sterling are in there, you might as well think of the euro for all intents and purposes. And Asian currencies, or the Asian bit, is dominated by China. If you look at the data, what you can see is that generally, as a percentage of global liquidity, what's happened is that capital flows have basically generally fluctuate within, let's say, a band of at most 1%, but broadly about 0.5% of global liquidity. And that tends to be the experience. What you've seen in the last 5 years is an unprecedented move into the US dollar. And that has already had two components of it, which are well worth understanding, because that might tell us something about the future path of the dollar. So you see that spike up to 1.5% on the left-hand axis, and that's showing moves into dollar assets. That has been made up of both components. Asian liquidity or Asian capital outflows accelerated dramatically through 2015, 2016. That was largely flight capital from China as a result of Xi Jinping's anti-corruption drive and the simultaneous and maybe unfortunate coincidence of actually that occurring alongside dropping of capital controls so they could shoehorn the yuan into the IMF's SDR unit, which would, dropping of capital controls was a precondition. After the yuan got in, they slapped those controls back on quite quickly, and the capital outflow hemorrhage essentially lessened, but it's still there. You're still seeing some drift of liquidity out of the Asian region. If you look at the European numbers in orange equally have gone negative. It's normally the case that Europe has a capital account surplus, and what they've seen really since the Eurozone banking crisis 2010 to 12 is you saw negative capital outflow from the region. Now, it's difficult to understand why that may have been in reality, but my answer is that it was really because there was a shortage of safe assets in the Eurozone, and Eurozone banks, or European banks, of course, also being big cross-border banks, needed to get safe assets. So they went into the US, where although they were scarce, they were more available than they'd been in the Eurozone. And because you had these austerity policies, particularly from Germany, issuance of bonds were significantly depleted. And that background is now ending. So what you're getting is not only a big increase in US liquidity from the Fed, what you're also getting is increasing supplies of safe assets from the US and from the Eurozone. And you've got Euro bonds being issued, which will also be a lure for Chinese investors. And I think what you've got is the potential for that orange line to pick up significantly, and maybe the yellow line, let's say that stabilizes at best, but the black line, which is the US capital flow, comes down. And if you look at the right-hand chart, these are the implications that you could see. We've plotted on that graph US capital outflow again in orange, pretty much the same data that you see on the black line on the left. And alongside, we put on top the US trade weighted index, the dollar, the DXY index, if you like. What that basically shows is a pretty good correspondence between the two. It's not perfect, but hey, it's not bad. And what that is suggesting is that the dollar could decline further as this capital outflow potentially accelerates. And I think it's this safe asset story which is really the key one. Now, if this is a normal dollar cycle, no reason to suggest why it may not be, then I think what you could be looking at is a 20% drop in the dollar from its earlier levels. And that would still mean that even after the fall in the dollar you've seen, there could easily be another 15% slide to go. Now, if we track that on this following slide, this is how we look at the US, or any currency for that matter. And our currency models, which are very different from other people's, effectively discriminate between what we think of as good liquidity and bad liquidity for a currency. The good liquidity is what the private sector itself creates, which on the left-hand side for the US is the yellow line. And the bad liquidity is what the public sector, or in this case, the Federal Reserve, creates, which is the orange red line. Now, generally speaking, most other people, if they take a monetarist view of exchange rates, will add those together. We subtract them. So we look at the difference. And that's what's really the key thing. So if you have a lot of private sector cash generation coming out of the US, whether that's, US technology companies or whatever, but indicating a high return on capital and a strong economy, then that yellow line is going to be buoyant. If, on the other hand, the Federal Reserve is printing lots of liquidity, then the red line goes up and it effectively supplies the needs of everyone with more dollars. So the difference between the yellow and the red should give us an idea of the excess demand for US dollars. And we plot that on the right-hand chart as our Forex risk index. Now, the Forex risk index has been advanced by around 12 months, just a little bit under it. I think it's actually 9 months on the chart. And the yellow line is the trade-weighted dollar. Now, rather than cheating and do a year-on-year rate of change, which wouldn't be fair, what we've done here is to look at percentage deviations on the month away from an underlying trend. So that's giving you contemporaneous movements in the dollar against, future, or if you like, future values of the dollar against contemporaneous readings of the Forex risk index. The Forex risk index advanced by 9 months. What it's suggesting at the moment is that what you're likely to see is the dollar weakening further. That yellow line is moving lower. In fact, even in the last month, it's moved down again. But what we're looking at is potentially a bear market that may well take the dollar down ultimately from its highs of about 20%. And I think that's one thing to bear in mind, because it effectively will change the whole complexion of risk assets in world markets. Let me say something about emerging market currencies, and then gold again, but it fits into the same narrative. Effectively, the left-hand chart is looking at what happens to emerging market currencies using exactly the same metrics. And this is looking at private sector minus central bank liquidity for EM relative to the US as a benchmark. The red line is our Forex risk index. The yellow line is the JP Morgan emerging market FX index, deviations from its trend. And what that suggests is you're going to get some stabilization in emerging market currencies. But, you know, as we've said earlier on, emerging markets will actually take that as an opportunity to monetize any capital inflow. So they will effectively move closely to the dollar. I think that extends also to the yen. So what it really means is that when you're going to get movement in the dollar, it's going to be against either gold or it's going to be against the euro. And those are the two areas that I would tend to focus on. Will the Europeans try and control the euro? You bet they'll try and do it. But what tools have they got? They've got open mouth operations. Typically, when you get the dollar euro at around 120, they'll try and talk it lower. They've had some success in the past of doing that. But, you know, I think the impetus this time is even greater. So I think it's going to be very difficult for them to actually hold this down. So I would expect you're going to get an overshoot in the euro. Maybe, you know, it could go as high as 135, 140 against the US dollar. Gold again, this is just looking at two alternative ways of looking at gold. And what we've said here is that let's just add together US Federal Reserve liquidity and People's Bank of China liquidity, given the fact that China is a big player in the world and Chinese investors are big players in the gold market. And although China is not easing at the moment, as we've indicated, the Fed is. So if you add future impetus coming out of the PBOC, what you're likely to see is potentially a still climbing gold price. Let me just revert back to the bond story, because this is something I think we need to also take a look at. The left-hand chart there is looking at the G4 yield curve, and what I've put on that chart again is US economic expectations. The reason for looking at the US is the US data is much more easy to come by, but I think it's pretty indicative of what's happening globally anyway. So what this is really saying is that historically, when you've seen a big jump in economic expectations like this, what you'd normally expect to see is the yield curve steepening. Equally, you can do analyses which would say, you know, let's look at the Australian dollar, let's look at the move of the Australian dollar against the US dollar, plot the yield curve against it. What would you expect? Moving the Australian dollar should have shifted the yield curve a lot higher globally already. So what you can say is de facto yield curve control may well be trying to hold or holding down what's happening in the US and global yield curves. I think it's a matter of time before basically you get yield curve steepening more. I don't believe that yield curve control will work. I think that the forces operating in the markets will overcome central banks. It's very interesting if you go to the last set of FOMC minutes that they actually ruled out yield curve control, arguably because it would just mean too much of a commitment in terms of balance sheet expansion. And that almost tells you that they're sort of fighting, they've got a finger in the dike, and they're fighting potentially a wall of money, given the fact that foreigners own 40% of the US Treasury market. And if you've got alternative safe assets now, such as Euro bonds, I think that's, it's a potential problem. So the yield curve, we still think is going to steepen. The chart here on this graph is looking at the historic precedent about liquidity and the yield curve. Now, okay, maybe we're lagging this, and hands up on that. We thought the yield curve would be steeper already. It's begun to steepen, but it hasn't really got there yet. And as I say, de facto yield curve control may be working. But ultimately, you've got to look at the pressures. And the biggest bubble by far in global markets are government bonds, and particularly US Treasuries. I mean, they should be nearer 200 basis points than 60 basis points. And that's what these analyses are saying. So I think that's where the problem is. And once you start to see investors moving out of bonds, at least in the initial stages, I think they're going to move into equity markets. So let me just say something finally about equity markets. And I'm going to shift on a bit further in the presentation, get through these charts to this area. Broadly, our philosophy, where we look at liquidity, we would pretty much say that for the fixed income and for the Forex markets, they are driven 80% by macroeconomic fundamentals and probably 20% by sentiment, emotion. If you look at the equity markets, I would kind of say it's the other way around. But it's almost 20% emotion, maybe 20% macroeconomics. And what's more, what you tend to find is that the emotion tends to lead the real economies. And that's what you can see on this graph on the, well, in fact, on the right, but the right-hand chart is derived from the left. And let me just go through that. We create a risk appetite index, which is based on investor positioning. That investor positioning data is shown on the left-hand graph, and this is the stock of world financial assets. We get this as holdings data from a variety of sources, from custodians, from stock exchanges, etc. It's electronically downloaded. We can do this for about 20 markets with about a 2-day delay now. So it's actually very, very speedy. And what this enables us to do is to distinguish risk assets from safe assets. And what we do is we put safe assets like government bonds and cash into one bucket, and risk assets, which are equities and corporate debt, into another bucket. And the differential is plotted as a percentage of the portfolio on the right-hand graph, which is shown as the red line. And that represents investor positioning. When the red line is higher, what you find is that investors basically have got lots of risk assets like equities and corporate debt. And when it's lower, they've got lots of cash and government bonds. And the bands at 20, 40, 60 are standard deviations. Now, again, if you look at the context, the world, which is what this is showing, went hugely risk off in March. The yellow line is world economic activity. What the data actually shows is that the risk appetite readings lead the world economy by about 3 months. So it's maybe in line, but what you've got to look at is the rebound that we're getting now in risk appetite. And the question to ask is, if you start to look around the world, what are different markets showing? And this is the, if you like, the 4 major markets: the US, Eurozone, UK, and Japan, and where risk appetite readings relate. Now, this is, if you like, a more sophisticated or technical version of the chart I showed right at the beginning, which was just a simple relationship between either equity holdings and safe assets, or a simple ratio between equity holdings and liquidity. So this is a bit more statistically robust, which are looking at normalized deviations. And the trend lines are drawn at 2 standard deviations, up and down. And what this basically illustrates is that if you take Wall Street, which is the top left, you can see there the extent to which investors went hugely, risk off in March. And that's, they've since bounced back. Where we are in the US market now is about middle area. So in other words, investors have about normal equity exposure within their portfolios. And one has to judge, given the economic outlook, whether that is correct or not. We would suspect it is correct. And we think that given the fact you're getting a recovery, and what's more, looking at some of the recent data on earnings revisions, you're getting very positive earnings surprises, upward revisions going on now. Maybe markets are going to be better supported than the media would suggest. If you look at some of the other markets than lower, the UK is ridiculous. I mean, if you believe in mean reversion, you've got to buy into UK equities, because they're the one market globally of the big markets that simply haven't rebounded. And, although you can make arguments to justify it's too many banks, too many oil companies or whatever, the UK is a pretty decent barometer for the world economy. It's a good mix of industries worldwide. So the UK should participate in this. Eurozone has rebounded to some extent, not as much as Wall Street. Japan kind of likewise, but I don't think the impetus in Asia is yet there. But Eurozone is certainly doing a lot of easing. And then if you come to the other markets, let's say the emerging markets, the BRICS are shown here. So Brazil has got some potential. Russia, well, okay, that's pretty much an oil story. So I think one would just have to make a judgment on oil and commodity prices, which, arguably if gold is going up, probably go up too. India looks interesting. not least because this is one of the cheaper opportunities to buy the Indian market over that period. China's, perhaps run a little bit too fast, but you've got potential there. And then if you look at some of the other bigger emerging markets, I mean, Turkey, well, hey, what can you say? I mean, that's rebounded, but it's up there. Poland hasn't. Korea has had something of a rebound. Mexico hasn't. So among the emerging markets, there's opportunities as well. So if you take a sweep across global equities, we would still say that there's opportunity to be had. Now, if I round this out and summarize again where we are, and maybe I'll go right back to the beginning and perhaps just show, I want to show one chart that I know I did skip over, which I want to come back to. And that is looking at where you would position in terms of equities on a phase diagram. And this is one of the ways that we look at equity markets, which is saying, look, you've got two axes here. You've got falling liquidity and expanding liquidity going to the left or to the right. And you've got risk positioning, which is saying, are investors highly invested in stocks or are they lowly invested? Presumably, logically, and actually empirically as well, it's much better to be in the lower right-hand quadrant because you've got low equity exposure on investors and there's lots of liquidity out there. And it's not so good to be in the top left-hand quadrant. So if you look at where markets are, this is where markets are positioned. You can see that there's a clustering at the bottom down there, pretty much most markets. Some have rebounded already. I mean, you've got Switzerland and Sweden maybe less attractively. Frontier markets, which didn't really have a big sell-off and have rebounded a bit, which are up there. Emerging markets are lifted because of China, which is the one market where you've got not much liquidity and investor exposure has rebounded quite noticeably. You've got Japan in the lower right. Japan hasn't got that much liquidity at the moment, nothing like some of the other markets, but you've got some great opportunities, I think. Germany is still low down there. Singapore's low. Liquidity is picking up because the authorities are monetizing. You've got Brazil down there, US there, UK almost off the page. People giving up, but this I think is an opportunity. And then, if you go to this snail diagram, this is showing how we move around in time. And what this is really trying to say is that you typically see an anti-clockwise movement in this chart. That's what's happened. You move through phases from buy through sell, and world markets are still, we think, in a buy stage. So generally, in our view, things are looking good. And out of this Jackson Hole meetings this week, I think what you're going to hear is more noises from the central bankers of saying they're prepared to do more if they need to. I think that you can see that evidence. If things start to wobble, they're just going to use the tools they know seem to work, which is pumping more money into markets. So if you come back to this chart, which may be the bottom line, what this is saying is that equity markets or risk assets still look very well supported from a liquidity standpoint. Paradoxically, as we said, as I said right at the beginning, look, the Fed balance sheet is falling away a bit, but that's not really intentional. That's simply because the private sector hasn't had the need to take up some of the more generous offers that the Fed has been making. And you've had a falling away of swap lines to foreign central banks because nobody really wants the dollar that much. So it's difficult for the Fed to expand its balance sheet, but liquidity is picking up. And even last week, you saw another jump in M2 data in the US, suggesting that liquidity growth is still buoyant. So that's fact number one. Fact number two is that money is leaving the US dollar. And you can see that again, if I go back to my earlier chart of the dollar, money is leaving the dollar as that left-hand chart is saying, away from that spike that we saw in 2016-17, which helped to elevate the dollar through that period. And it's moving towards the Eurozone. So that's the currency I think one's got to think about. And then finally, the issue about fixed income. Do you really want to own fixed income in this environment where you've basically got the real risk of inflation coming through? And that's what I would argue is that this is this unprecedented growth in liquidity. And what the gold market is saying is that we're already getting monetary inflation, and monetary inflation plus cost inflation is what comes through the high street. And I think that, the evidence, I would say, anecdotally, is that people are not price conscious anymore. They just want to get out there and spend money. But hey, let me stop and see if there are some questions, and we can address that.
Thank you very much, Michael. Yes, if anyone has any questions, then feel free to put them down in the chat below.
Now, Tom, you may have to read out the questions because I can't see them here, if there are any coming through. Oh, you see, actually, there's a couple here. There's one here. There's one from Mark Hughes, which says, as inflation picks up and treasury rates adjust to 2% in 10 years, what happens to JGBs? Yeah, okay. I think JGBs. I think JGB's yields go up too, and I think that you've already seen, if you go back to 2019, rising JGB yields, sort of independently almost of what's going on elsewhere. I think my reading of Japan is that if you come back to the deflation in Japan, one has to blame the Japanese authorities to some extent for that, and you've got to say that demographics were clearly an issue. But the other thing is that Japan is sitting right next to the biggest source of global deflation that we've seen, which is China, and that has been a major impact. So that's another thing to factor in. Once the Chinese economy starts to lift off and they start to pump some more money in, which arguably they've got to do, ready for next year, which is a signal year for China in terms of the party congresses. I think you're going to be seeing more inflation. I think the JGB market, rather like the Bund market too, will see rising yields. So I think this is a global phenomenon. Absolutely. There's a question from Oscar, which basically says, is the biggest risk inflation? I think the biggest risk and the biggest opportunity are inflation. I think that's the way that I would see if you take it as a risk. The biggest risk of the bond markets is certainly inflation. I think that you can see that in terms of just looking at the break-even inflation rates that are coming through on the TIPS market, and we know that's not a particularly efficient guide, but it seems to be moving up significantly. And the reason that real yields are going down is very simply, it's not because there's global deflation happening, it's because there is some sort of de facto yield curve control going on in nominal bonds. So I think the fact is for bonds, absolutely, I wouldn't want to get anywhere near the bond markets. What you've got is some of the lowest volatility readings ever, certainly in the US Treasury market. Volatility, as we know, has fallen away. But it's very interesting that if you go back and you look at what happened during periods of yield curve control historically in the US, and if you look at the experience of Japan in the last 3 or 4 years, bond market volatility actually was not low. It's been rising. It was relatively elevated in both periods. So what you find is maybe the yield curve doesn't move that much, but actually you can see fluctuations in yields through the period. So I think that's one way to think about that. Yield curve control doesn't necessarily mean a static long bond. And I think the other point I'd throw in is that my experience of looking at the Fed is that the Fed is not really that worried about the bond market per se. That may seem a heroic statement, but what they're really worried about is the corporate credit market. And it's that which really exercises them. That's what tends to move the Fed rather than the Treasury market. I think they'll accept yields rising. They'll think that's probably actually what they would expect to see given their inflation targeting. But it's if you start to see disruptions in the corporate credit market where there's a problem. There's another question here, which is, do the risk appetite readings account for passive investment managers who hold fixed allocations to equities and are 40% of the market? Yes, they do. This is all equity holdings. It would, you could say, well, okay, maybe things have changed because you've got a bigger component there, but our risk appetite indexes are trend adjusted. It's difficult for them to sort of change dramatically in a short space of time if there's a step jump. But certainly what they do indicate is that what you've got there is an evolutionary allocation to equities or risk assets against safe assets. So we take into account some trend adjustments. So the short answer should be yes. Question here from Mike Longthorne, which says, if there's a change in US political regime, does that change your outlook? Well, I think that I think it's a very interesting question, and I wish I knew what the outcome would be. And I think we're still slightly struggling with, or everyone's slightly struggling about what the outcome will be. But I would say, look, if you look at it from the bond market perspective, I think that I still think it's invariant to almost who's in there. The Republicans or the GOP or Trump or whoever you like to say have been big spenders this time around. I mean, we forget that even before COVID, there was a lot of fiscal spending going on. COVID's added to that. And if you get Biden coming in, I think he's going to do more of the same. I mean, the agenda that he's talking about is basically more fiscal spending and more tax hikes. I think, good luck with the tax hikes. It's going to be very difficult to get those through. So I think there's more spending. And, clearly we know that, modern monetary theory is basically, influencing the Democrats rather more than others. So I think that they're going to start to use those kind of tools. So I think from the perspective of the bond market, I think that I'd be pretty worried, looking out of yields. And then in terms of the dollar, I can't see how the outlook really changes the outlook for the dollar, really. If miracles happen and, Trump remains where he is, which is looking pretty unlikely, what you're going to get is, I think, further downside on the dollar for the simple reason that he's going to use tools he's used before. Biden, as I said, effectively going to do the same thing. So the fiscal deficit in the US starts to jump dramatically. There's a lot more safe assets out there. And if you get the in between, which is sort of, the hanging shards or whatever the equivalent is today, where there's an indecisive poll, then I think the dollar tanks. So I think in terms of the dollar, you've got that issue. And then as regards equity markets, as far as I can see, the outlook would be one where, Biden's obviously talking about bigger tax increases, but I just don't think he's got the ability to tax, the FANGs as maybe some people want. So at the end of the day, I think that we're in a sort of, limbo land where I think things continue pretty much as they are. And I think the only one thing one would say is that if there is a change of presidency, maybe the international markets get more of a lift. Question from Vince, which says, oh, sorry, one I missed out, which is, I missed a couple out here. So let me just try and do this. There's one here from Jay Keane, which says, PE seen high everywhere with a V-shaped recovery in earnings. Do valuations matter? Well, yeah, I mean, valuations do matter, but I think the question is, how do you value things? And I think, early on in this COVID crisis, we put a research report out which said, look, if you're running a standard dividend discount model, a Gordon growth model, and you factor in reasonable assumptions, what you'd say is that actually earnings in years 1 and 2 comprise only 4% of the total value of a growth stock, and perhaps up to 10%, maybe 12% of a sort of zero growth value stock. So years 1 and 2 earnings don't really matter that much. And the point is that if investors can look through the V and look to the other side with some confidence, then they're going to buy equities. And at the end of the day, I think that equities are bought as part of a portfolio. And what you really need to do is it's supply factors which can influence portfolio allocation as well as demand. So if you get bucket loads of liquidity supplied, it's got to be reallocated. And people are reallocating into equities and into real assets. And I think you're getting that. The other thing to say is that valuations change in terms of what is the benchmark. And, PEs have been with us for different periods, but it wasn't only PEs that were important. If you go back to the 60s, people looked at book value, not PEs. PEs have been more recent. And then prior to that, it was dividends. So I think you've got a changing, if you like, weather vane as to what you look, or barometer, or what you look at. And liquidity is as valid as any other. And I think it's important right now. I'm not going to say it's always important, but I think that, well, for me it is, but I think that generally what you've got is you've got to pay attention to these supply factors in the market. One from Patrick, which says, an environment for equity outperformance. Do you see a particular region that will outperform? Well, I think my answer would be, I think you can certainly see sectors that will outperform. And I think if the gold market is a good benchmark, which it typically is, about 9 months after the move in gold, you normally see commodity prices lifting off. And I think we're seeing evidence of that. Look at copper now, for example. Look at oil, what oil has done. So I think there's evidence that we're seeing that commodity pick up. And if that's true, then you're going to get a lot of cyclicals and commodity stocks which are going to perform. I think the other thing is that I still think that technology is going to do really well, despite the move we've had. And I think the reason for that, and this is just an anecdote, but I think it's an interesting anecdote, that I sit on an endowment fund, and a week or so ago we had one of our quarterly meetings with some of the other big Wall Street investment banks, or the big Wall Street investment banks. And I said to each of these, this was JP Morgan, Goldman, Morgan Stanley, I said to each of them, well, just tell me, when are you guys going back to the office? And out of the three, JP Morgan and Goldman said, well, basically maybe by the end of the year we could be getting 50% back, but the firm policy is that we'd be the other 50% not until the middle of next year. And then Morgan Stanley said, policy is nobody back until middle of next year. So what you've got is an extension of this, lockdown or whatever, working from home or out of office. And so I think the whole technology phenomena, continues. One of the other things that came up in that call, which, I think is maybe public information now, but one of the investment banks said they were talking to Ocado, the delivery, home delivery service, and Ocado had told them that they did in the last 15 weeks, they'd done the equivalent of 15 years budgeted sales. And that's the extent to which, online shopping is really picking up. And if you look at online shopping, it's still only, it's on an S-shaped growth curve. It's really still at the lower cusp. So there could be a lot more to go. So I still think technology. Let me continue. Does the liquidity framework suggest any concerns with the high concentration of equity gains in a handful of tech stocks? Well, I think the answer is yes and no. I think the point is that, and this may be, maybe a philosophical answer, but I'd say, is this a market in stocks or a stock market? And, if you take it from a demand side standpoint, you look at individual value, then you've got to say, well, it's a market of stocks. If you're more interested in, supply factors of the supply of risk assets, or the lower supply of risk assets relative to the huge supply of safe assets that's coming in, you've got to start thinking it's a stock market, and people basically want to balance their portfolios. So, we think about sort of, liability driven investing. And what that means is that your liabilities, the duration that you want in your portfolio, has got to bear some reflection to the amount of assets that are available. If you can't get duration because central banks have bought duration out of the bond market and they're just pumping in cash, which is a zero duration asset, the only way you're going to match your liabilities to immunize is to basically buy equities. And I think that's one of the factors. So yes, I'm concerned, but I'd like it to be more evenly balanced. But hey, that's how markets work. Richard Saldana's got a question. It looks like COVID cases are likely to spike in the Northern Hemisphere in the autumn. Is this anticipated in terms of projections, equities, bonds? Well, yes and no. I mean, I may be, I don't know, maybe I'm more optimistic. I mean, I think that, I think that the whole thing has been kind of overdone in a way. I mean, obviously it's been a tragic situation, but at the end of the day, has this lockdown really been necessary? And maybe Sweden is a counterexample, which would suggest, maybe not. And, the fact that it's not being reported, particularly in the UK right now, is there are no deaths from COVID. And that should be headline news, and it clearly isn't. I think the answer is that, I haven't taken into account directly, if the COVID crisis just fades away, I think that, or if you get a cure for COVID, I think markets would spike, or risk assets would spike up on the upside significantly. And I think if there is, we were wrong and you get more spending, more COVID cases, governments are just going to spend more money. So I think that supports the current case. Let me continue. Take as a question from From sorry, my takeaway is a more fiscal spending across the board implies a potential accident in the bond markets, which makes a rapid rise in interest rates likely. Absolutely agree. I think this is the key thing: is that bond markets are the bubble, and that's what there's only a small accident is needed. And one of the things that, if you look back to the 1970s, which was a point that we made in an earlier presentation, how did inflation come through? Inflation came through in terms of lengthening delivery times. And if you look at a lot of these PMI surveys, although they've come back a little bit, supplier deliveries are still elevated, which says that delivery times are still actually getting quite long. And at the moment, what I would argue is that if you just look at it anecdotally, people are not price conscious. They want to get out and spend. They want, a release. The champagne cork is coming out of the bottle, so to speak. And I think this is the risk of inflation beginning to pick up. And as I indicated, in the last month, if you annualize the US data, you get 9% CPI inflation, and that's unrealistic to extrapolate it. But it's a warning, and that's the problem. I think we've run out of questions, and maybe we've run out of time because we're just over the 1 hour mark. But unless there are any other questions, I'd say thanks very much. Look forward to re-engaging maybe next month, and keep watching liquidity. And this is a big week, as I said, for central banks with the Jackson Hole thing. And you're going to hear a lot more about yield curve control, average inflation targeting, and the magic money tree, or modern monetary theory. Thanks very much.
Thank you very much to everyone for joining, and thank you very much, Michael.